Good evening, viewers. We are live for another episode of COVIDCastJA Business. We're at episode 49. Can you imagine? So those of you who have been with us from the start, we're family now. We've been together for so many episodes. We've gone through so many different topics. And let me tell you, in the next few weeks, we have some more exciting discussions. Many of you have been reaching out to us to ask us about areas that we have not yet touched. We have heard from you, so you have to stay tuned. And today we are continuing. In fact, today is the finale of our discussions, hidden issues in business, and we're talking about pension planning today. Now, I know sometimes when you come on for the first time, you're thinking to yourself, so this is the finale of a series. Yes, this is a series of 3 episodes. We talked about the checklist for wills. Last week, we talked about estate planning, and today we're wrapping up with pension planning. What we said? Pension planning. And we have 2 very exciting guests who will be joining us shortly. Now, please remember, we prepare memos for pretty much all our episodes. So can you imagine there is a full memo with the checklist for your will creation. We've given you guidelines, we've given you tips. We've also created a memo for this episode on pension planning that breaks things down in a very simple way that you can follow. Stay informed with the PSOJ. Get the weekly business tips by emailing us at sme@psoj.org. You got that? sme@psoj.org. You can also log on to smallbusinessportal.com where you will find, because we're at episode 49, which means that if this is your first episode, you've missed 48 episodes. And what better to binge watch than COVIDCastJA? So please go on to smallbusinessportal.com. We're right here too on Facebook Live, that you are able to go back through, scroll back through the various items of content that we have. We have had experts over this 1-year period talking about so many different business issues, and we want you to be a part of that conversation. Tonight, we are joined by Sanya Goff, who is president of the Pension Industry Association of Jamaica. And we're also joined by Antonio Spence, Senior Assistant General Manager of Pensions, Client Management and Business Development at NCB Insurance Agency and Fund Managers Limited. Mags, I see you. Very timely session indeed. Romeo Stewart, I see you. Glad to have you here. Now, ladies and gentlemen, please, right about now, you need to be sending some messages to your friends, because this lady who is joining us, the president of the Pension Industry Association of Jamaica and attorney at law, Sanya Goff, a dynamo, an expert in her field. And let me tell you, after a session with Sanya, you're going to get some planning in place. Now, Sanya is a partner with the law firm Hart, Muirhead, Fatter. She was called to the Jamaican bar in 2003, and her main areas of practice include corporate, commercial, pensions, and intellectual property law. Sanya is a 2020 Eisenhower Fellow and serves on numerous boards, including she's a director of NCB Financial Group Limited, National Commercial Bank of Jamaica Limited, and Jamaica Producers Group Limited. She's also chairman of Stratus Alternative Funds, SCC, an alternative investment company, as well as president of the Pension Industry Association of Jamaica. Sanya and her husband, and I think his name may be Gavin Goff. Gavin, we see you. Welcome. Co-founded the Adult Learning Centers of Jamaica, a non-profit organization to provide adult literacy programs in Jamaica. She's a very active member of the Jamaica Bar Association. She's also a member of the UK Association of Pension Lawyers and the International Pension and Employees Benefit Lawyers Association. And she's also the 2017 recipient of its Libby Slater Award. She loves spending time with family, traveling, reading, and kickboxing. And this dynamo is going to kickbox us into some pension planning. Sanya, always a pleasure to have a conversation.
Hey, Rochelle. Thanks for having me. I'm always excited to talk about pensions, but that introduction was fantastic.
So you know that when people sometimes hear the conversation about pension, some people start yawning and saying, is this necessary? But after this episode, so guys, Dotsy, please send some messages out to your friend. Nicole Brown Price, I see you. Justine says, I'm ready right here with my notebook. And guys, if you're also wondering where is the SME memo, please go to smallbusinessportal.com and download it. And you can also email us to get it, because you'll get some very useful tips that you can just be making your notes. But Tanya, you get very excited about pensions, and we wonder why. What are the 3 pillars of retirement savings? Because we're really talking about retirement planning here.
Correct. So in Jamaica, we have a 3-pillar system, and it's very common in countries around the world to have a 3-pillar system, though not all countries have that. And it consists of your first pillar, which is the government run social security program, which in our case is the NIS. Okay. The second pillar would be private pensions, and we'll get into more detail around that, but that's your retirement schemes, and you've got your employer set up pension plans. And then you have the third pillar, which would be your personal savings. So it would be these 3 pillars that really constitute and set up the framework for retirement savings in Jamaica. And if we break them down, the first pillar being NIS, everybody knows about NIS. You're required to contribute 3% of your income. Your employer matches 3%. It's mandatory. And for self-employed persons above the minimum wage, they contribute 6%. And those are recent increases to the contribution rates. If you're over 18 and working, you're required to contribute to NIS. Now, oftentimes we refer to NIS as a pension, government pension. But the truth is, it's 2 things. It's pensions, but it's also insurance. It provides, as the name suggests, it's a national insurance scheme. It provides a number of benefits for persons. Many people don't know. Maternity benefits, ill health benefits, funeral grants, as well as a pension.
NIS?
Yes. So the question, though, the adequacy of those benefits, but the benefits are there. And of course, there are conditions attached to whether or not you can actually access the benefit. So that's the first pillar. Okay. When you look at the second,
when you look at our pay slip and we see, for instance, that NIS benefit coming out, rather than looking at it as a burden, what we need to look at it is an investment in our future retirement, right, as a government plan. Okay.
Right. And it's part of the, like I said, it's part of the entire framework, right? So exactly. You never dismiss your NIS benefit. You know, and the truth is, the minister has said and announced that a lot of changes are underway to really reform the NIS program to ensure that it does in fact provide a meaningful benefit for persons when they retire. Okay. The second pillar, private pensions. And that's your employer-sponsored pension arrangement. So Grace Kennedy has a pension plan. You go and work for Grace Kennedy, you have to join the pension plan. And then you have approved retirement schemes. And approved retirement schemes are set up for persons who are self-employed or work for an employer who does not have a pension plan. Okay. Or the employer may have a pension plan, but you are not eligible to participate. So you have some companies that they may have a plan, but they've closed it. So new members are not able to join. Or it's a plan for certain types of workers, so factory workers, but the admin staff aren't participating in the plan. The executives aren't a part of the plan. So you may well be in a job where there is a pension plan. You are just not eligible to participate. So if that is your situation, or you're self-employed, or your employer has no pension plan, then a retirement scheme is what's there for you as a part of the private pensions arena. And then the third pillar would be your personal savings. And so we always say, in addition to the social security program administered by the government, in addition to private pensions, always supplement that with additional personal savings. Okay.
So Sonia, when we talk about this concept of pension, because some of us view pension as our children, can we talk about this whole concept of pension? What is pension? Can you clarify?
It's really a retirement fund that, that provides you with a stream of income when you are no longer working. Ideally, it provides you with this income for life. And so that's really what it is. And I want to talk later about that whole concept of my pitney is my pension. Yeah. That's really important for us to disrupt that mindset. But really, that's what it is. It's that benefit that you get when you're no longer working, and it will cover you for the rest of your life. Now, the question is, always comes down to adequacy. And a lot of people will ask, how much money do I need to have when I get to that stage of life to ensure that I can live comfortably? No, that's really a individually, determined answer. But we generally, as a rule of thumb, will say in the industry, 70 to 80% of what you were earning during your working life is what you want to have in retirement to live comfortably, to manage, generally your health needs, etc. So 70 to 80% is what we call in the industry, the term is the replacement ratio. That percentage of your income that you were earning that you want to replace in retirement.
Okay. So what are the main types of pension schemes?
You'll often hear, Rochelle, people talk about defined contribution plans or defined benefit plans. You may hear the phrase DC or DB plans. So those are the two main plans you have. A defined benefit plan is just that. Your pension is based on a specific formula, that gives you a defined benefit. It's usually a factor of the number of years you've been working and your salary. So it's 2% of your final salary times the number of years you've been working. So it's a defined benefit. You're pretty sure as to what you ought to get once you know these variables. In the case of a DB plan, though, it's the employer who makes that promise to you. The employer says, when you hit retirement, I promise you this defined benefit. And so it's the employer who takes the risk, so that if the pension fund doesn't perform very well, if it's invested badly, the market, it has a massive downturn and you lose all money, the employer still has to pony up and meet that defined benefit. So the employer takes the risk in a defined benefit plan. Then you have defined contribution plans. That's where you contribute to the pension plan. Your employer usually matches, and you usually hear 5 and 5, though it doesn't have to be, but you usually hear 5 and 5 contribution rates. And if the fund
let me hear this 5 and 5, because I know sometimes people hear the 5 and 5, but they don't want to ask the question. They think, well, since everybody else know what 5 and 5 is, it sounds good. What is it, 5 and 5? So
the traditional DC plan, defined contribution plan in Jamaica, sees the employer contributing 5% of their earnings, of their salary, and the employer matching with 5%.
Okay.
Well, that being the case, that's generally what you see. A typical 5 and 5 plan is what we call it. But there is no obligation for the employer to contribute 5 or the employer to match. The employer could contribute 1%. Yes. The employer could require you to contribute 8%. So, but traditionally you see a 5 and 5. So let's use a 5 and 5 as an example. In a defined contribution plan, you put your 5%, the employer matches with 5%, and that money is invested. If those investments do badly and you lose the fund loses all its money, that's your pension down the drain. In other words, you take the investment risk. You as the employee, you take the investment risk. So you can imagine that employers don't really like DB plans any longer. In fact, DB plans, you don't see an employer setting up a DB plan nowadays. And you find many employers who had or have DB plans are likely to be closing the plan to new members, or they're winding them up, or certainly they're not. They're looking for ways to de-risk and to shift the risk out of the DB plan, understandably. Okay. And so those are the two.
So we have the DB plan that is a defined benefit. So regardless of the performance of the fund, the employer is responsible for ensuring that your pension is met. Right. And then you have the defined contribution, where that is the contribution is defined, but it is the performance of the plan, and the employer does not bear that risk. So in other words, and in fact, regardless of the type of plan you are in, you need to be paying attention to the performance of the plan.
You ought to, yes. But the truth is, you're far more concerned when it's a DC plan. And I just reminded Rochelle that the first time we met was when you were working on a major pension conversion. In fact, it was the biggest pension conversion the island had ever seen. So yeah, I'm just remembering. Okay, that's how we actually met over pensions. Okay.
Over pensions. And I think both of us get equally excited about pensions.
Yeah, it's
because we know, and you know, I see some young people like Nicole Brown Price online, and I see Max Blake and Romeo. And one of the things too is that, you know, as we're discussing pensions, is there an age that all of a sudden it's supposed to matter to you, or is it supposed to be mattering to you from you start working?
From the start. You really need to be saving from the very beginning. And I get it. I get that it's the, you know, when you're starting to work at 23, 24, that's the last thing that you're really thinking about. You're just trying to get your act together, make ends meet. You know, you have certain goals that you want to meet, get a car, get an apartment, whatever it may be. But truthfully, it's something, put something aside from the start. No, it's done for you when you are working with an employer that has a pension arrangement, because you are automatically put into the plan and you don't really have a choice. The money is taken from your salary and you move along. But for this, we're in a dispensation now where, one, a lot of young people are not looking for the long service award. They're not looking to stay to be vested after 5 years. You know, they want to, after 2 years, they're moving to another job. And so there are lots of limitations that we see in our regulatory framework. For example, there is no minimum vesting period. Most plans have a vesting period of 5 years.
What is the vesting period?
So vesting, when you're with your employer pension plan, it's how long you have to work with your employer to be able to get the employer's contributions. So when you hear me talking about a defined contribution plan where you contribute 5%, your employer contributes 5%, those contributions by the employer don't become yours. You're not legally entitled to it until you vest in the plan, and that's usually 5 years. That's what you see typically. But there are vesting periods that are 10 years. There are vesting periods that are like staggered. You vest 10% every year. So even at 8 years, you're 80% vested. You know, only after 10 years would you be 100% vested. And one of the things we're seeing with the kind of changing face of and changing nature of work is that younger persons are walking away from employer contributions because they are leaving company plans before they're vested, because they're not interested in staying for long periods of time. And the general kind of outlook is 5 years is too long. And so you have a different mindset than, for example, you know, our parents' generation, where they worked with a company for years, for decades, you know. And so because of that, we definitely need to see an adaptation of the regulatory framework to meet that changing nature of employment. Yeah.
So Sanya, when we talk about so we talked about what is a pension, the types of pension schemes, and also sometimes we're having these discussions like a pension fund versus a pension scheme, and we're starting to use these terms interchangeably. What is the difference between a pension fund and pension scheme? And viewers, if you're just joining us, we are here today with the president of the Pension Industry Association of Jamaica and attorney at law, Sanya Goff. Now, if I were you and I have Sanya online and I could ask some questions in the comments, I would just go ahead and ask. Adza, I see you. In fact, yes, some don't know what vesting is. And sometimes we cut in and go through it and we just say, one of these days I'll find out what vesting is. Nicole says, I don't know, 5 and 5. Donna says, no longer are they committed to any one company. So there is really a changing nature of work. And we are also seeing more young people leaving school and going straight into business.
Right. Yeah. And in fact, that's why, you know, the retirement scheme product becomes so important, because a lot of people think to themselves, well, you know, I'm not working with a company, so I don't have that as a benefit or an option open to me, but you do. Approved retirement schemes like NCB Smart, Scotia Bridge, Proven Rock. I'm just giving names that you would have heard in, you know, generally advertised. Those are examples of approved retirement schemes, and you would be eligible if you're self-employed, if you have your own business, etc. Because you're right, it's much easier today to do your own thing and for it to do very well. But making that effort to save for retirement is really important. And, you know, Rochelle, there are lots of other issues that it comes to. You know, we've been operating our regulatory framework for almost 20 years. and coverage is still so low. It totters between 9 to 11%. And that's unacceptable. And we really do need to consider what that choice architecture looks like in Jamaica, meaning expecting people to kind of take the initiative to enroll in a retirement scheme on their own isn't working. People aren't doing it. So how do we look at the framework to see, what changes need to be made to get people into retirement schemes without leaving it up to them?
Exactly. I see Dwayne, this guy, Graham, he says, I'm currently vested after 5 years. How can I get more from my pension plan? Do I go to another pension plan offered outside my workplace? Will it be enough? So I don't know if you can answer the enough, because you don't know how much in the tilly, but how can I get more from my pension plan?
So Dwayne, at this point, we want to know that you're contributing the maximum allowed on the law. So right now, what the law says is that you can contribute up to 10% of your income, and your employer can contribute up to 10%.
Mm-hmm.
But the Act goes further to say, if your employer does not contribute 10%, the full 10%, you can contribute the difference, provided the aggregate contribution is no more than 20%.
Okay.
So if you are vested after 5 years, that means whatever your employer has contributed to date is yours legally to get as a pension at retirement, because you never get the employer's portion as cash. So if you leave that company 5 years and a day later, you're not going to get the employer's money as cash. You get that as a pension at retirement.
Mm-hmm.
Your benefits, there are a number of options, and including getting a refund of your contributions, but employer's money, you get that as cash. I mean, you get that as a pension at retirement, not cash.
What about voluntary contributions?
Right, so that was what I was going to say. So in your typical defined contribution plan, your contribution rate is set, as you said, a defined contribution rate, and let's say it's set at 5%. You can make voluntary contributions up to that maximum of 10. Remember, if your employer is only making 5, you can top up an additional 5. So you can contribute up to 15%. If your employer, using the example, is only contributing 5%. If your employer was contributing 8%, the percentages are adjusted, right? So what I'd say to Dwayne is, one, make sure you're contributing the full amount. The second thing he asked was, can he go outside of the pension plan and contribute elsewhere? And the answer is no. Right now, you cannot be an active contributor to more than one retirement arrangement. So if you are enrolled in your employer pension arrangement, max out up to 20% as best as you can. Make sure you're getting your full 20%. And you're not able to do anything else. However, the plan is for the law to change, for you to be able to contribute in addition to what you contribute with your employer. Okay. But currently, you can't do 2 plans actively, no.
And you can't do a plan where you've maxed out the 20% and a retirement savings scheme.
No, you can't be an active contributor. And even if and when the law does change to allow you to contribute to your employer plan as well as a retirement scheme, you're still going to be at the income tax limit, which is 20%, unless that changes.
Okay, Lord, let me tell you something. The acidic commentary coming in. I am loving it. I see my Sergeant Yolando. I see you, Stacy, and also, say sometimes when you give voter thanks and you thank everybody, if you leave out anybody, Sagicor Lifestyle, I see included. Yes, recognizing that. Nicole asked, I would like to know how to assess which independent pension scheme is a good one. We're actually going to have Antonio Spence from NCB talking to us generally about some of the products available. Sanya also mentioned other companies, so Proven, Sagicor. I'm afraid again, if we go call out any name.
Almost most of the major, financial service providers have a retirement scheme.
Yes.
JMMB, Sagicor, BNS, they all do.
Yes.
In terms of determining the best one, honestly, Nicole, you're going to have to just do a little due diligencing on your own. ask questions, set up meetings. All of them are, have reps who are willing to sit and talk to you. Some retirement schemes allow you to be a lot more involved in what we call investment decisions. And so you can choose with a little bit more granularity where your contributions are invested. Some retirement schemes just ask for your risk profile. Are you risk averse, moderate? So once you kind of choose a profile, then your money gets channeled into specific pools and pots of investments. But so you have to kind of do some diligencing, ask questions. I mean, given some of my positions, I wouldn't advance, but and I don't know it on that side, on the client side anyway. So
yes. And the thing too is that when we are seeking this kind of, we need to go around to the various providers, ask the questions, make the comparisons, and ask the simplest of questions, whatever is your question. I'm seeing a lot of comments and questions coming in. I'm going to jump back to them shortly, because we were looking at the difference between a pension fund and a pension scheme, Sanya.
Right. So you're right. You hear the terms used interchangeably, and by and large, not a big deal if they're used interchangeably. But to be precise, a pension fund. When we say a pension fund, we really are talking in the Jamaican context to your superannuation funds. That would be the fund set up by your employer. Mm-hmm. So the National Water Commission pension plan is a pension. That's what we talk about when we say a pension plan versus a retirement scheme, which would be the approved retirement schemes we've been talking about: Scotia Bridge, NCD Smart, Proven Rock. That's when we say pension scheme. But the truth is, I mean, the once you say scheme and plan, or retirement scheme, people know very quickly what you're talking about. Yeah.
Okay. And I see we have some good resources here. Stacey says also look at the performance of the scheme over the last 10 years. Thank you very much for that, Stacey Jarrett.
One thing I would say to Stacey's comment is that the average person may not have easy access to that information.
Yes.
So, but it's a good question for people to ask when they go, knocking on doors to get a sense of what that fund performance looks like. And how the funds are invested. Those are very good questions. Another good question to ask is the level of communication. Mm-hmm. Because you will find that you're enrolled in a retirement scheme, and outside of getting a benefit statement once for the year, you really don't know what's happening, with the scheme, and you may feel that it's just a kind of bank account just sitting somewhere. And so you really want those to engage with a retirement scheme that's active and sends regular communication to you, so you know what's happening, accessible. That's important. We do have a very regulated private pensions environment, and so I would say that trust that your retirement schemes are supervised by the FSC. They're audited regularly. There's a very involved regulatory framework that you have to adhere to in order to remain registered as a retirement scheme. And so, you're not going to find yourself, accidentally contributing to a scheme that's rogue or, not operating in compliance with the law. Yeah.
Okay. Ali Ju, I see a question, a good amount to pay per month for a private scheme. I'll save that question for Antonio. Windell, good evening to you. Donna asked, working with government for over 20 years, am I in a safe pension state? I'm going to, I see Sanya's, so I think that's a loaded question for Sanya to answer in her position as president of the Pension Industry Association. Althea, what age do you stop paying it? And I think, Althea, you mean what age do you stop paying pension contributions?
So in the case of a employer pension plan, assuming you're working there until you retire, you contribute until you retire, as long as you remain eligible for the plan.
Yes.
For retirement schemes, you access that benefit at the stated retirement age of the scheme, which is anywhere between 60 and 65. Mm-hmm. And you're expected under the law to contribute at least once for the year. And so you can decide in a retirement scheme arrangement your contribution intervals, but you must contribute to remain an eligible member of the retirement scheme. You ought to contribute at least once for the year. And as I said, up to the aggregate of 20%. And the expectation is that you contribute annually until retirement. Now remember, with a retirement scheme, and this is an important thing for listeners, for viewers, is that when you contribute, your money is locked in. It's locked in until you reach retirement age. What does this mean? Tomorrow you have a pandemic scare and you need some money, and you cannot access that money. It's locked in until retirement. You can transfer it to another retirement scheme. You can move from NCD to JMMB to Proven. You can transfer it to your employer pension arrangement. Let us say you are contributing to NCD Smart, and then all of us, then you got a job at, just using the examples, Grace Kennedy. You can port that money into the Grace Kennedy plan, but it's locked in. You can't draw down on it, right? Okay. That being said, there is a lot of discussion around amending the legislation to allow for what we call hardship withdrawals. And a lot of countries around the world allow hardship withdrawals, a recognition that life happens, you know, an unexpected pandemic could just hit you, and things have to change. And so there's discussion around allowing for what we call hardship withdrawals. In fact, there's a lot more attention around it now because of COVID. And what's being contemplated is that you would be able to make 2 withdrawals during your lifetime from your retirement scheme, up to a maximum of 20% of the value of your fund, of your account. Okay. Preliminary, no, it's not even in a draft bill or anything, but it is something that's being proposed. And hardship withdrawals, you know, people feel it's very polarizing, because you have some people who are, you know, true purists when it comes to pensions. If it's for your retirement, don't touch it. Yeah. And then there are people who have a little bit more of a balanced view, which is, we get that, but before you even get to retirement, you need to live, right? You need to survive to get to 65. And so, you know, allowing withdrawals under certain specific circumstances and limiting the number are ways in which the government is likely to try and control and ensure people don't just use it as a bank account, you know? Okay. But yeah.
Stacey, you know, I like Stacey has provided her number and her information. She has also indicated life insurance, very good point, can be used as a supplemental retirement income. Dwayne, we see you, thank you. Camille follows up on a question from on Dwayne's question. She just wanted to know, why aren't you able to contribute to 2 plans? That's a function of legislation.
Right, that's what the law says now. The rationale for it, I have no clue, because if at the end of the day, the fiscal impact to the government is no different, because you're capped out at 20%, you should be allowed to contribute beyond your employer arrangement. And because we expect the law to change, it's indicative that the legislatures see that there needs to be some more flexibility, right?
Okay. Thank you for that. Nicole says, when you hit retirement and are vested with a company, does it automatically start to be paid as in your pension, or are there actions you have to take to activate the pension payments?
It should be pretty automatic. Once if you worked until retirement, the notifications are sent to the administrator, the trustees notify the administrator, and it should happen automatically.
And usually your organization, that whole retirement process, there's usually a retirement process in organizations. I saw a question from a Gavin Goff here. Can you borrow against the value of your pension?
No. Not only can you not borrow, so when you say borrow, as in like use it as collateral, Gavin? Who's upstairs?
Yeah, Gavin, do you mean using it as collateral? Let's see when Gavin responds. But generally, you can't borrow against.
You can't assign, you can't put a lien, you can't say, listen, I have about 2 million coming to me when I retire. No, you can't. And in fact, what the law says very clearly is that any attempt to assign, any assignment is void. It's not even enforceable. And a lot of people don't know this.
You have your pension and you're like, don't worry, just lend me that money because I have my money. I have my money.
Right. It's not enforceable. No, when you are in receipt of your pension, right, nobody cares. Do what you want with it, right? You can assign it and lend it, burn it. It doesn't really matter. But while you're accruing your pension benefit, you can't say, okay, I have this money accrued and I'm about to retire in 2 years, and so, let me borrow some money, and that's the collateral, that's the security. Yeah. Funnily enough, though, there are quite a few I've seen. Those like loan document forms for cars and hire purchase for.
Yes, I was going to go there.
Yeah, you see it on the forms, but it's actually not enforceable.
And I think there's sometimes some persons that they will ask the question in respect to their employment, that if they, for example, if they borrow money from their employer, that their pension, that there can be deductions from their pension. What you say? Not no go so?
You can't. And I know that this is a practice and it is incorrect. If your employee owes you money, you as the employer cannot instruct the investment manager, the administrator, or the trustees to set off or hold back any part of that pension benefit in order to settle a debt owed to you. You cannot do it. In fact, there are times when the employee himself will write to the trustee and say, I'm leaving employment, I owe my employer $5, please give me my pension benefit or my refund, in that case, less the $5. And I usually advise my clients, pay the man his money. He can then turn around and settle up with his employer as he chooses, because you as the trustee, your obligation and the investment manager is to pay the benefit. So you pay the benefit. Don't disrupt that. You pay the benefit, and who need to sort out debts can sort that out
in the background. Yeah. Okay, and Sani, I can tell him the comments are blowing up. So a lot of the questions that are being asked are questions that I would have asked you. And just the point, Dwayne said such worthwhile information, and he's thanking you, Sania. Yolanda says you need to bolster your pension plan with other investments and savings. Excellent point.
So that's the third pillar, Yolanda, that we would have talked about, right? With personal savings.
Yes. And Eulalie Thompson says, what if you miss a year of contributing to your pension scheme? Do you lose all your money?
No. Usually the account really just goes dormant. You don't lose the money at all. And Antonio can speak to how you reactivate and come from that status. But no, you would not lose your own money that you have contributed. Absolutely not.
Okay, and I see Adza, great question, Adza. Can an early retiree who is getting a pension start contributing to a pension fund or scheme until full retirement?
Yes. If you've left your employer pension plan and you've left as an early retiree and you want to continue contributing and you have not yet hit, so let's say, use some examples. Let's say you left at 50. You left the Grace Kennedy pension plan at 50. But you are now doing your own thing. You're consulting, you're freelancing, and you want to continue to contribute, and you go to NCB Smart, and their retirement age is 65. Certainly, for the balance of the 15 years, you can continue to contribute.
Okay, good. So that was thank you, Adza, for that question. Yandi Yaya, good to see you on. What if the individual dies before retirement age? What happens to the fund? I love this question.
So most funds, whether it be retirement schemes or superannuation funds, meaning your employer plans, will have what you call a death benefit provision. So usually you would have named a beneficiary for who would benefit from your pension if you were to die before retirement. So it would usually be your beneficiary who would get that. And there are other conditions, right? Were you vested? Weren't you vested? The type of plan it is it DBDC? But all of that is set out in what we call constitutive documents for the plan. And in the case of a retirement scheme, equally, whatever you've contributed, if you die before you reach the retirement age, that goes to your designated beneficiaries. So the excellent point really that I want to kind of underscore here is ensure you designate a beneficiary.
Yes.
Because what you don't want is that money to be tied up in any kind of probate or mix up. What you want is that you separately identify beneficiaries for your pension plan, because you don't need to probate a will in order to disperse those monies to beneficiaries on the pension plan. So it's a very good question.
Yeah, and we if you are joining us for the first time in this series, we did talk about this in last week's episode in estate planning. So we would urge you to go and look at that that episode, to rewatch that episode, and it's very important, because a lot of times, when we get a job, we're so happy for the work that we sign up the papers. When they ask that question about beneficiaries, we're just like, I just really need to get my first salary, so we write estate, and we're like, next month I'm going to put a beneficiary in. Just put a beneficiary, and you can change that beneficiary.
Right. I would just love to share a story. And in fact, Antonio is probably has heard this before, but I once had a client, a situation where a gentleman had, he had indicated that his spouse, well, it was a pension plan that had a spousal benefit, really. Mm-hmm. And what a spousal benefit means is that there's a specific benefit in addition to your pension that you're going to get. Your spouse will get a benefit. And this gentleman had indicated who his spouse was, let's say it's Rochelle, and that was that. He and Rochelle separate. Rochelle moves to the United States and they start living separate lives. So, my man can't live alone. So he moved in Sanya, right? So Sanya and this gentleman are living together as man and wife, basically. And everybody, Christmas party, him and bring Sanya, any local, everybody knows. And over time, after many years, as far as anybody's concerned, Sanya is the wife. He passes away. Sanya starts to get the spousal benefit because no sufficient checks aren't being done, records are not updated, nobody knows what's going on. The spousal benefit is paid to Sanya because, as far as everybody's concerned, she's the spouse. Well, after almost 12 years of Sanya getting her good pension spousal benefit, Rochelle comes back to Jamaica and on the door of the investment. She won, because the fact is that she's still the spouse. And for the Jamaican men listening, you can only have one wife. You may not know that, but in Jamaica, you can only have one wife. So the legitimate wife, the real wife, the legal, lawfully married wife, turns up and wants her benefit. But the fact is that it had been paid for over 10 years to the wrong woman. So it just goes back, really. I mean, what ended up happening was that the incorrect benefits, the payment to Sanya stopped, and they had to, the sponsor, meaning the employer, absorb that cost of settling up with Rochelle, because the risk of the lawsuit and the exposure and the reputational damage would have just been too much. So that's how that got settled. But it really spoke to the importance of record keeping. Ensure you talk about you're writing up things on your benefit statement and updating your benefit statement, updating your records with your investment manager and the administrator. But checking that benefit statement, when it says estate, is that who you want? When it has a particular name, is that the person who's still your wife? Or do you need to change it? Because you need to, and then of course, honestly, before you move in woman number 2, start out with woman number 1. To me, that's the biggest takeaway. But anyway, so point I'm making is that the record keeping part is important, and it has caused a lot of issues. People with different children and dependents and who ought to get. So that checking of the statement and ensuring it's up to date. Don't wait until you're at retirement age, because the truth is you may not, something could happen and you're not able to update the statement when you think you could. So just make the effort to ensure your records are up to date.
Thank you for that. And I saw, as Yolanda said, wowzer. And the fact, Yolanda, that this wowzer happens, it's a regular wowzer. I see information for Yolanda and Stacey, and thank you very much for this, viewers. See, we have resources that are available. Kathy, well, Dwayne says, and I will continue to have one wife. Good. Kathy Lynn, Thank you for responding. So I think Kevin had asked a question earlier in regard to the 5 to 10 year. So she says pension is usually monthly for life. The 5 or 10 year guarantee means pension payable in any event during the guarantee period. If the pensioner survives, the guarantee period pension continues for life. So just for us to be clear, there are two conversations. There's a conversation about vesting, which may be a 5 or 10 year period, depending on your pension documents, your pension trust deed and rules. But in regard to the payment of your pension, how long do you receive a pension? Do you receive a pension until you die?
Yes, your pension is for until you die. But the point Kathy was making is that there are ways in which you can elect for a variation of that. So you could say, for example, I want a 5-year guarantee, and it's 5-year guarantee and plus your life. So at a minimum, I want to know that I'm going to get my pension for 5 years.
Yes.
So if I die after 2 years of receiving my pension, the balance of the 3 years would go to my beneficiary. Similarly, if you said I want a 10-year guarantee for life, that means at a minimum, I'm going to get my pension for 10 years. So if something happens to me between the first day I leave that first day I start getting that pension benefit and 10 years, it does my spouse, my beneficiaries are okay for the balance of that 10-year period. And then some people just say for life. So if I walk out of the door and a bus knock me down and I don't even get the pension for a day, that's just it. It was for your life. So some people opt for this variation to have that guarantee. And the actuary, like Kathy, who is one of our best actuaries in Jamaica. So Kathy,
I said, wow, aren't we privileged? We have a lot of experts on.
Yes, Kathy is one of the top ones. So good to see you, Kathy. But yes, so as Kathy, that's what Kathy was explaining. I imagine somebody may have asked a question attached to that. Yeah.
So you see, you have really joined the right episode, viewers. We have lots of experts available. Kevin says, my employer pension plan retirement age is 60. Why not age 65 or 70?
Good question, Kevin. No, what the law says is that the retirement age can be set anywhere between 60 and 65. And so employers will usually choose 60 or 65. You don't usually 63. But anyway, so it's between 60 and 65. More and more pension plans are equalizing the retirement age for men and women, because a lot of the traditional older plans had women retiring at a earlier age than men. But you're seeing that equalizing happening. But there is a lot of discussion around moving that retirement age to 70 or even 75, because people are living so much longer. And the only thing I would say, though, Kevin, is that even though your retirement age is 60, there is allowance under the law to do what we call late retirement, which means you can go for an additional 5 years. So if your retirement age is 60, you can retire early 10 years before your normal retirement age. So you could retire early from age 50, or you can go for an additional 5 years, usually with the consent of the employer, usually for an additional 5 years up to 65. So even though it's 60, and a lot of plans are 60, it is possible, usually, I don't know what the plan terms are, but typically you could go for an additional 5 years.
5 years. Sweet Pea Vermont says, please also speak to the underage dependents and naming a trustee. This is critical, especially if persons have very young children. Can you touch on that for us, Anya?
So a lot of times when we talk about naming a dependent, we're, a lot of times we're talking about our children, and they're not the age of majority, so they're minors. And so they could not, if you were to pass away while they were minors, you could not pay the benefit to a minor. A minor can't enter into a contract, they can't receive money that way. And so it's important to name a trustee. Now, this is different from the trustee who manages and operates a pension plan. This is a trustee who will receive the money almost as guardian, custodian for your child. And so it's important, yes, to name a trustee. And I think, Sweet Pea, that's such a good question, such a good point, because there are pension plans where the HR department or the administrators don't give that extra support. So you just write the name of your child and you don't think anything of it, and no one is checking to satisfy, okay, who are these people? Are we talking about a minor? There's no notation, there are no instructions. So it's important that, yes, if it is that you're naming a minor, that you also indicate someone who is of majority, who is an adult, who will act as trustee. And sometimes it may even be important to name more than one trustee, because we have had a situation just recently where a minor is the beneficiary of the pension benefit, but the trustee has passed away. And so we have a situation where a trustee was named, but no, it's almost as if no trustee was named. And we have to now determine going to court to get a guardian appointed. Because that's what the law says. If there is no trustee identified, then you have to go through this court process. So sometimes having more than one person is the right approach.
Okay, let me tell you, this episode, that my producers are just reaching out to me to say, wow, the comments and stuff are coming in. We still have Antonio waiting backstage. I see a very interesting comment here from Kathleen. Kathleen says, greetings everybody, let's ask some more questions about more topics, not just benefits. What about coverage and adequacy? What about rate of accumulation and how much is enough for retirement? So we're actually so Sandy, you leave that to Antonio, or do you want to touch on that?
I don't mind leaving that to Antonio, because I think there were a couple of other things we wanted to talk about, especially for MSMEs and what their options are. So Kathy, great question. And we before you joined, we did talk a little bit about the fact that adequacy is what's important, right? So we talk about moving the coverage rate from 9, let's call it, with recent statistics say 11%, but that's because the actual workforce has contracted. But let's say 11%. That even if you got to 99%, if what you're getting doesn't cover you in retirement, is not an adequate replacement, then it's as if you didn't really have any security, right? So I think that's important. So we can leave that for Antonio. What I will say, we're coming down to time. Is that it, Rochelle?
Yes, because there are, you just mentioned for MSMEs, what are some of the considerations MSMEs should have,
Sure.
and you also have some general points that you want to leave our audience with.
Okay, so let's go get into that and wrap up. I'm just kind of looking at the time as well. So for MSMEs, we generally say, as a rule of thumb, if you have fewer than 100 employees, setting up your own superannuation fund doesn't make sense. It's not worth the administrative burden, the regulatory risk, the obligations. And so going into a retirement scheme, as in enrolling your employees in a retirement scheme and ideally matching or contributing on their behalf as well, is what we would encourage. And so it's the way to go. It's easier for you. You don't have to think about the administration of it. You don't have to think about compliance with the FSC. All you know is that you deduct from people's salaries, put it into the retirement scheme, and you do a match. And I like to push for a match, because the truth is, matching your employees' contributions has been one of the biggest influencers to get people to continue to contribute. That free money, knowing that if I put in $5, my employer is putting in $5, so I immediately double my money, is an incentive. It's a powerful incentive. And so even if you're not able to afford to match, certainly contribute something, because it does encourage your employees to continue to contribute in the retirement scheme. And then the value is that when they leave your employment, there is no calculating benefits, etc. They can move to another job and continue to contribute to that retirement scheme on their own, because the account is not fixed to the employer, it's fixed to the individual. So I think that in terms of the best options for small companies, I would say go the retirement scheme route, and it gets people in the system, right? It gets people saving for retirement. I think that's important.
Sanya, are you hearing me?
Yeah.
Okay. In terms, I see Stacy mentioning the tax benefit, but there is normally some nuggets that you leave us with of why is it important to consider saving for retirement?
Okay. So Stacy, you're correct. One of the biggest things is that the retirement scheme, whether it be approved retirement scheme, superannuation fund, it's tax advantaged. So your contribution is made before your income is taxed. So you get more income. And the accumulations, the interest, the accretions are also tax-free. It's usually on what we call the drawdown or the decumulation phase, when you're getting the pension, that it would be taxed, right? And then you even have a tax-free lump sum as well that you can get. So it's a significantly tax advantage system. And I don't want to say tax deferred. I don't want to say tax-free, because it's not tax-free. You do get taxed. I don't want to say fully tax deferred, because there are some people who may not hit a threshold and they don't pay tax. So let's say tax advantage. So biggest benefit. Number one. Then number two as well, as I said earlier, you can pass a benefit to your beneficiaries and dependents without having a will probated and going through that whole process. And then at the end of the day, Rochelle, as we kind of close off, you know, my kind of tagline for 2020 and 2021 is retirement security is so important. Old age poverty is real. We all know people who lived well when they were working and did not make adequate preparations for retirement and are selling fancy pieces of art like you have hung up on the back of your wall there, Rochelle, to make ends meet, right? Because they're living in an impoverished state in retirement. And these are people who lived well, they just didn't adequately plan. And it's important that retirement security is important, because it's important to disrupt intergenerational dependence. You see that mentality of my picnic is my pension? We have to stop it. We have to stop it. Put in place the measures to allow yourself to live an independent, dignified life in retirement. Relieve your children of that burden, because when you do that, you put them in a better place to make adequate preparations for themselves. And so we need to disrupt that intergenerational dependence that feeds that intergenerational poverty and allow our children to have a better opportunity. So we have to make that decision now. And I would just say in closing that the women who are listening, we are particularly vulnerable. We live longer than men. We experience ill health retirement events usually earlier than men, statistically. We usually are not paid the same as our male counterparts. Yet we experience the greatest number of disruptions in pensionable service. Looking after children, looking after dependent parents. And so we have to recognize, especially as women, that we're in a different category. And we are the ones that are the caregivers and tend to have the mentality, my children will look after me. Because, you know, after all. So we need to just think carefully. And as women, we need to take retirement security, all of us, but I really want to make a special appeal for women to take retirement security as particularly important. And so that's really what I want to close on, encouraging everyone to take the first step, educate yourself. You know, their information is out there. You said a lot of your listeners are kind of sharing information. The PIAJ as well, we are, you know, lots of resources, and FSC as well, they have a lot of resources as well. So let's take that step, listeners, to disrupt that intergenerational dependence, to look about leading that independent, dignified life in retirement.
Okay, thank you so much, Sanya. And I see the comments just rolling in. This has been such an informative session, and you've really left us with something. Sydney Cole says, many thanks. Really appreciated this session. But very important, we need to break that intergenerational dependency. Your picnic is not your pension. And we are living longer, both men and women. And as young people too, we have to start thinking about retirement from we start work. Sandra, I see, wow, the comments are rolling in. Thank you so much, Sanya. And I know there are additional questions now that are going to come in for our next guest. Ladies and gentlemen, if you're just joining us, we are so grateful that this episode will be available right here on our Facebook Live, because you have to go watch it over. Sanya has also prepared very informative, very easy, in easy language for us to understand. She has prepared a memo that we have made available. Please email us at sme@psoj.org if you are not currently on our mailing list, but please go to smallbusinessportal.com. It will be uploaded there. Rachel McClarty, I see you saying thanks, Dotsy, Stacy, and thank you all. We are now going to be joined by a gentleman, Mr. Antonio Spence, who is Senior Assistant General Manager and Head of Pensions, Client Management and Business Development of NCB Insurance Agency and Fund. We also want to thank our sponsors, NCB. Antonio has provided a wide range of insurance, banking, and investment advisory services to corporate and individual clients. Don't look at how he looked young, for 20 years, and has held senior management positions in the insurance and the banking industry. He has been integrally involved in the growth and development of NCB Insurance Company and NCB Insurance Agency and Fund Managers from 2006 to present. He has responsibility for the pension, credit life, and employee benefits business of the company. So please send in your questions. Yandiaya says, excellent free information. Look at that. At the PSOJ, we are here. We are serving our MSMEs. Antonio, you've heard the discussion that we've had. Any opening comments that you have for our viewers from where you sit in your pension work with NCB Insurance?
All right. Thanks, firstly, for having me, Rochelle, and I just want to say good night to all of your viewers and listeners if they're unable to view. I want to pick up exactly from where Sanya left about sort of breaking that mindset that we have around the thing like, Pitney will be my pension, or pushing the buck sort of down the line and hoping that by the time we get to retirement, things will take care of themselves. She would have mentioned that, to be honest, what tends to happen in Jamaica is that usually during the earlier phases, whether it is that the person is employed or the person is a self-employed person, they don't tend to be focused as much on the whole business of retirement. And the truth of the matter is, in order to have both a sufficient retirement and in order to be properly prepared, you actually do have to start early. It is the truth. And so that, of course, happens because, psychologically, we're not thinking of ourselves as a 60 or 70 or 80-year-old person. Financially, some of us have challenges regarding the student loan. We're pursuing, the nice car or the first home, or looking to get married in that earlier phase or not. But certainly there are some things that if we're not careful when we're younger, we tend to ignore. And this is one of those very, very, very big things that we ignore. And so we have to kind of break that and get into a headspace that says, one, the minute that I start to earn an income, I need to be putting aside some money to be able to have a pension. And the simplest way for me to express a pension is just a payment or pay that comes after it is that you work. So you're essentially paying yourself. So if you decide to not pay yourself earlier, you're pretty much shorting your paycheck in 25 or 30 or 35 years. That's really what it is. Yeah. Now, I don't know about anybody else, but I would like my paycheck to be as big as it could possibly be. And so if you're an employed person or self-employed person, I want to encourage you to make sure if you are not a part of a pension scheme, so you're working somewhere and the employer doesn't have a pension arrangement, look at having one set up. And we're going to go into the types that may be available and how they work, generally speaking. And similarly, of course, if it is that you are with an employer that has a pension arrangement, you need to pay attention to what you're contributing. If it is that you hope to have enough by the time you get to your retirement. We may have some MSMEs in the house as well who may be saying, boy, what if I'm looking at doing this thing for myself and for my staff, what sort of approach should I take? What will work sort of the best based on my current situation? So I'll go into that.
Yes.
Let's start first. Generally speaking, the two types that we're looking at would be an approved retirement scheme that Sanya mentioned before. And in this case, NCB has one such called the Smart Retirement Plan. And the second is a superannuation fund or a company pension plan, as a number of persons know it, right? And that is the type 2. So I want to focus firstly on the approved retirement scheme, because in my mind, this is the type of arrangement that is key to us being able to make big leaps and bounds in terms of persons' ability to be able to access a pension structure that they can use, that is easy, and it's something that they can set up literally tomorrow morning, as soon as if it is that they decide. So, SMART, the approved retirement scheme. So what it is essentially is a personal pension. So if you have somebody, for example, who is self-employed and they're not contributing to a scheme, if you have somebody who is employed, but by virtue of their employment status, they cannot contribute to their company's pension plan, they're not allowed to. So say you have a company that has a pension plan, it says it can only be for some types of workers, right? Maybe just the full-time people, maybe the part-time people can be a part of it, or just the factory people, as Sanya was mentioning before, but maybe the administrators are not allowed to be in it, or the executives. So those persons who fall outside of that grouping, they can, of course, become a part of SMART as an approved retirement scheme. So once you're not an active member contributing to another scheme, they can be a part. 2, if it is that they're between ages 18 and 69, they can be a part of it. 3, once they're earning an income and they reside here in Jamaica, they're able to be a part of it. You see how simple that is? Like 1, 2, 3, right?
Yeah.
So just to break it down, if you have a business, it's you and 10 people in that business, right? You own it, or you're an employee in that business and you want to have something set up where it is that you can contribute to something, a smart retirement plan would be perfect, because it is an approved scheme that would allow individuals to be able to contribute. All right. So that's the ground, that's the base. Typically,
before you go on, I know a question that our viewers may be asking, because when you start your business, or you may be employed and you are not contributing to the pension plan. You might say to yourself, you hear what Antonia has about that approved retirement scheme thing there, but I could use my money instead, and I'm going to invest in real estate, and I'm going to buy stocks, and that is how I'm going to set up my my pension structure. Why should you still consider an approved retirement scheme? Sanya went through that saving should be an investment, should be a part of your consideration. But some people say to me, you know how I good on the stock market? You see how much money I'm making on that? You know what? I'm going to buy some apartments and rent them out. Why should you really consider being a part of an approved retirement scheme?
All right. So firstly, it's a good idea to always be saving and investing, full stop. Yeah. So we're not knocking that at all, right? Exactly. What we're saying here, though, is the approved retirement scheme or an approved pension structure provides a more tax-efficient way of going about the situation. So as an example, essentially what you're doing is you're taking, say, 75% of the typical dollar, right? So let me put another way. If an individual, say, earned, and I'm using flat numbers here, $100,000 for the month, and he was contributing 10% of his income, right? $10,000 as a tax, because it's a tax-exempt deduction, would go immediately into his retirement scheme, right? Now, let us say if it were the other way, and he were to look to take that same equivalent 10,000, he would have to be doing it from post-tax dollars. So he would have had paid taxes and statutories on the amount before. So I mean, what you're looking at is a tax efficient, tax effective way of going about preparing for your retirement. And only an approved retirement scheme or a super fund provides that level of tax benefit. So yes, it's good to be able to save in that way, but take advantage of that tax benefit. So what you're really doing is you're taking about, let's say, $7,000 or $8,000 of your money, and then taking $2,000 of the money that would have otherwise been used to pay your taxes, and that amount is what is going into that $10,000 versus taking your raw $10,000 that has already been taxed and doing your thing. You know what I mean? So enjoy the benefit of the tax right up front. Yeah? And that's what your approved retirement scheme provides, or your approved super fund.
Thank you very much. You convinced me there, Antonio. So in terms of the approved retirement scheme, can you tell us a little bit more about how they operate? And if I wanted to come in and start and sign up for one, is sign up? How does it all work? What kind of questions I need to be asking you, Antonio? Or do I just hear your sweet mouth and say, I'm going to follow what Antonio say?
All right. So Rochelle, firstly, let me give my description of what the ARS is a little more, and then tell you. I mean, sign up is very, very easy, to be honest with you. So firstly, how does the ARS work? You can contribute up to 20% of your income. Check. 1. 2, if it is that you're an employer, you can contribute up to 10%. So anything from 0 to 10% of that employee's income can be contributed to the Smart Retirement Plan. The employer is not mandated, they are not forced to contribute, but if they contribute, they can do so up to 10%. And we would want to, as Sanya would have mentioned before, we want to encourage employers to be able to make that contribution on behalf of their employees, because it is one of those key things that help employees to be able to dive in, go in, and they want to take advantage of that sort of right away. Right? 3, you want to make sure that if possible, you do your deductions on a tax-free basis. So have your employer run it through payroll so that you can enjoy that payroll deduction at source. So you will say to the employer, I want to contribute, say, 15% of my income going forward, and that employer will do the deduction and they will send it to us. Everything is online now, so you send your direct deposit directly for the credit to the respective member. Thing done. Yeah. Sign up is very easy to Rochelle. So let's say somebody came and they wanted to look at getting something set up. I mean, it is typically something where we sit down with a person, we get to understand what they earn, how much they earn, their risk profile, because there are elements in the approved retirement scheme, for example, that will speak to the fund that they invest in. I want to make sure that we correctly match the investment appetite of the person that wants to set up, along with the goal, that is the time to retirement, and to make sure that we have a correct matching on the fund side of things, right? We also want to sit with them and examine what they contribute, because as we mentioned before, even though you're required to make a minimum contribution of 5%, really what we want to be focusing on is, will my contributions be sufficient to allow me, when I get to the age that I want to retire, to have enough? So will I have enough to replace 75 or 80 or 90% of my income, right? And that is a big thing. So that conversation would happen at that sit down, and then we would plot the path, right? And say, okay, based on what you want to achieve, you are 35 years old now, you earn so amount per annum. Really, if you are to get to 75% or 80%, this is the level of contribution that you need to be able to make. now and going forward. All right.
I'm seeing some questions come in. Now, Dwayne says, does the contribution of the employer continue after being vested with the company? Can you take that question?
Sure. So all contributions are vested. So once if the employer makes a contribution, it is vested. If the employee makes a contribution, it is vested immediately. So there is no waiting 5 years or 10 years for that vesting to happen.
And that's in the approved retirement scheme.
Yes, yes. And just a spin-off of that, if it is that the employee decides to leave, the employer, of course, would no longer be required to contribute. Employee may be able to, if it is that they're going into new employment and they don't have an approved pension scheme contributing to they can continue to contribute to their smart retirement plan.
Okay.
Right? And similarly, the employer, as they get a new member of staff and they want to make sure that that person is enrolled, we make that very, very easy. You just indicate the respective person and we'll have the enrollment documents done and the person is enrolled and they can begin contributing.
Okay.
Right?
Doreen says, oh my goodness, can we trust the employer to pay it over on time?
No, what we have found is that employers do honor their obligation, right? And there is no benefit to them, not paying over their respective pension proceeds, right? And I believe by law as well, they're required to pay over those pension proceeds. If memory serves, I think it's within a week or 2 weeks after the end of each cycle. So, they ought to pay. And we have, as I said, we have found that employers have been quite good in paying over their contributions.
Okay. And Yolanda Dixon asks, what happens in the event of death of a contributor to the ARS?
All right. So for SMART, as is the case for most other ARSs, let me deal with it in two phases. If death occurs before the individual has retired, then the proceeds are usually paid out to the named beneficiaries in the percentages that the member would have indicated to us previously. So, for example, if they had said to us, hey, I would like to have my spouse be paid 50% of the benefit and my child, John Doe, be paid the other 50%, then on death, that's exactly what would happen. If death occurred after the individual has retired, then what would happen is, depending on the option that the individual chose in terms of a payout, so whether it was 5-year, 10-year, joint and survivor, and we can chat a little bit about that afterwards, then the pension would be that the portion of the pension would be paid to the surviving party or parties, as would have been guided and would have been set out by the member prior to death.
Yeah,
right?
and also just following on this question, Yolanda, and for those of you who were not able to join us for the first 2 episodes in this series, we did go through the will checklist, but we also did a session last week with Camille Facey, and she went through some of this information on estate planning. So we urge you to actually go and watch those episodes, because some very useful information as you are doing your general estate planning, because even as you're doing retirement planning, Antonio, you have to be doing your estate planning. Kathleen always gives us some provocative questions. Kathleen says, Antonio, why is your organization, and she actually just clarified, not lobbying for contributions not paid from past years to be paid in later years for people like self-employed who cannot always make contributions in the year earnings are earned?
All right. Well, I want to thank Kathy for that question. And certainly A number of the regulations are now being looked at for tweaking and adjusting. So, Kathy, this is an excellent point, and I mean, I agree with this from two perspectives. One, sometimes the self-employed persons, the income and some of what they may face in prior years may be a bit difficult as they transition their businesses from one phase to the next. And so, you know, it would be good for them to be able to not necessarily lose out on the impact of those contributions in terms of their retirement years. So we will certainly be adding our voice to that particular point. So thanks for that.
Yes. As we proceed, Antonio, in terms of the approved retirement schemes and just generally pension planning, what other information do you want to leave our guests with that you know, as we are pondering on our next steps that we really need to be thinking about?
Okay. All right. So firstly, one, we have some good information already shared. So that the first thing is that. Two, I would say it is useful to begin your search if you do not have an approved retirement scheme in place. If you have a business that is employing, say, less than 100 people, or if you yourself do not have a pension arrangement in place, right? NCB has our smart retirement plan. We'd certainly be open to wanting it to be a part of our scheme. But it will start there. So let's start with some positive action. So reach out to us. You have my name. My number is 876-469-1985, and I can repeat it for you a little afterwards. If you want to be able to have a sit-down discussion with an advisor to look at your current situation and to look at where it is that you would like to be, I think that's a great first step. Let's just keep it real simple, right?
Yeah.
With that consultation, we're going to be able to give you some guidance as to what you will need from a contributions perspective to be able to get there, right? And then we can take all of those subsequent steps to be able to make sure that you get started, and then, of course, that you have sufficient to be able to take it to the very end, right? I would say that's exactly the message that I'd want. If it is that you have employees, whether your business is a 2-man outfit, a 10, a 15, a 20, my number is 876-469-1985. Call me anytime, WhatsApp me, super responsive. You want to make sure that you take good care of those employees, right? One, having a pension arrangement actually does allow you to be able to solicit better quality employees first. Second, in a number of cases, remember that these are people that will be working with you, in some cases, 5, 10, 15 years. They will be giving their lifeblood and a lot of their meaningful days. Because we know what we know, we have to help them to be able to make good decisions for their own selves financially, right? And it starts by making sure that we have something set up to give them that encouragement, to allow them to be able to get to a good place. Exactly. So not all persons might be able to do a 5%. Some might be able to do a 10 on the employee side. Some might only be able to do 1 or 2. No matter. Start where you are at, right? You can use it to be able to help keep some employees that you want to keep. So say, for example, if you're looking at it and you're saying, if my employee stays with me, I will contribute 1% if they have been here for a year, 2% if they do 2 years, and up to 5 or 6% as the time goes by. You can use it. It allows a very creative approach to managing those employee relations and helping those staff members to be able to move and to transition. So it does start with a conversation, though. So let's talk, and then we can get something that sort of fits ideally exactly what it is that you want to do, and
Mhm.
your team, your staff, etc., that they want to do.
Thank you very much for that, Antonio. And I see you answered. Kathy had asked, why are employers contributing to approved retirement schemes? Sharon just asked, if you joined an ARS and then you start working with a company who has a pension scheme, what do? You preempted that question from me, Sharon. And Kathy actually answered, Doreen, you can contribute to a different scheme if rules allow. Anything you'd want to add to that answer?
No, well, just one small thing. You have the option to be able to, because they're portable, if you're contributing to an approved scheme, approved retirement scheme, you can actually transfer it in with the approval of the trustees for that entity, if you like, or you can simply discontinue contributing, because remember, by law, you can only contribute and be an active member in one. You can simply leave the benefit in your approved retirement scheme and contribute to your employer's scheme. As a matter of fact, even further, if you get to a point where you decide to leave that employer before retirement, you can also transfer that balance in to become active again in your smart or approved retirement scheme and transfer the benefit, that employer benefit, into smart.
Okay, thank you. So, ladies and gentlemen, what an episode. We have just heard from Antonio Spence, Senior Assistant General Manager of NCB Insurance Agency and Fund Manager. And of course, Antonio has provided his information. I can tell you he's super responsive. 876-469-1985. Call Antonio, get the information. Remember, there are other organizations that also offer approved retirement schemes. Go and visit them, ask your questions, but certainly get started. We heard today from Sania Goff, President of the Pension Industry Association of Jamaica and attorney at law. She has also provided for this week's SME memo, a very useful guide to some of these questions that have been asked. You can go back through that memo, make your markups. Please do not keep this information to yourself. Share and collaborate. Ensure that we are breaking that intergenerational dependency. Old age poverty, do nice. It's time that we ensure that we put things in place, that we are breaking this for our family, for the next generation. Sharon says, thank you very much. Informative session. The questions that have not been answered, we will direct them to the appropriate expert and we will provide answers. It looked like this episode needed a part 2. This pension discussion. Again, if you missed, this is the final episode of our series, Hidden Business Issues in Business. We looked at the will checklist. We also talked about estate planning, and we wrapped up tonight with pension planning. Memos are available on smallbusinessportal.com. You can rewatch the episode, send in your email us at sme@psoj.org so that you can get our weekly business tips that we send via the memo. Now, Tracy and Wisdom Reed asked, the number is 876-469-1985. That's Antonio Spence. Thank you very, very much for joining us for this episode. We went a little over time because we really needed to get that information in and to answer your questions. Thank you for your active engagement as we plan for our future. We are starting a new series next week. We are starting to look at the entertainment. Oh my gosh, I don't even want, because we're going to send out the video demand, so because you have to join us every week, 7:30 p.m. For COVIDCastJA. So join us again next week. We want to thank our sponsors, the NCB Group, the JMMB Group. COVIDcast is brought to you by the Private Sector Organization of Jamaica. Join us again next week for another episode. Walk good, sanitize, stay safe. See you next week. So you have a great idea to start. So you have a great idea to start a business, but you don't know where to start. We completely understand. You have a lot of questions and almost no answers. Smallbusinessportal.com is here to help. At smallbusinessportal.com, you gain access to information on loan, grants, and investment opportunities from verified financial institutions. Guess what you also get? Useful business tips, access to training. All these services combine to make your business idea into a reality. Start your journey today at smallbusinessportal.com.